Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
So happy to have you guys along.
We are.
You know, I hope that this radio show does not seem like the fastest hour in your lives. I guarantee it does for Sherry and I. We've got a lot of stuff that we want to cover today. As many of you know, I write for a lot of major media sources for Robert Powell and the USA Today and Retirement Weekly, Investopedia, and we get questions and comments from you guys that come in every week. And so part of the segment is going to be asking some questions. We got one: should a person take a whole life policy and convert it into a universal life policy to pay an insurance agent commission? Mm-hmm. And the answer is maybe, maybe not. But I certainly wouldn't do it without understanding the ramifications. A second thing is, how should a financial advisor communicate with you? What should you expect? What should you look for? You know, we get interviewed a lot by prospective people saying, is FEG the right fit, the Financial Enhancement Group the right fit for me? Mm-hmm. So I gave you some of those answers of what I would ask somebody else other than us, and of course asking us as well. We're gonna spend some time talking about required minimum distributions again. A lot of questions and comments are coming up with that. You get 10,000 people a day turning age 65. And so more and more people are reaching that magic age of 70 and a half. We're going to explain the rules to it a little bit better. But the one thing that I want you to understand, folks, is that you do not have to wait to 70 and a half to start those required minimum distributions. And when I look at the financial planning that most people do that don't have a proper strategy, they do two things exactly in opposite of what they ought to do. They take Social Security the first minute they can get it at age 62.
Yep.
And lose 8% a year of their income for every year they took it early before their full retirement age. And then the second thing is they don't start taking money out of IRAs and 401ks until they reach 70 and a half. If you are not working and you're ready to retire, I would strongly encourage you that we sit down, we have a cup of coffee, because we really need to invert those two things. We need to be using our IRAs and 401ks sooner and delaying our Social Security, assuming that the rules don't change, our health doesn't change, but the amount of income that you can have. And remember, that's what retirement is about. It's about replacing your standard of living. It's not about assets. Right. Not about having $1 million in an account. Yeah. It's about having a $50,000 income stream, mm-hmm. right? And I'm not talking about annuities or annuitization. I'm talking about understanding how to use the money that you worked so hard to put inside of that account. So stick around, enjoy the show. You got a question or comment, you can shoot us an email. Consider this at yourlifeafterwork.com. And remember, if you miss part of the show, you can always find it on our website, yourlifeafterwork.com. Simply click on FEG Insights. You can find my newspaper column, the blog posts that come from the rest of our team, as well as this radio show and the segments that you need. Sherry and I'll take a break. We'll get right back into the show.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. 4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Very, very happy to have you along.
We are.
It's always a fun time to be on the radio show. Sherry, I got caught in the middle of a conversation the other day where somebody essentially asked me what they should be expecting from their advisor in terms of communication. And it brought up a series of issues and things. If you've not heard me talk on this show before about business models, then part of this may be a little bit different. But just the basics, if you will. When people are interviewing financial advisors, there is a checklist of things that I provide people to say these are the questions that you ought to be asking, and many of them are overlooked. Sherry, you've heard me say before that it takes 4 things for a family to say, Joe, we want to work with you in the Financial Enhancement Group. And the first one is, do we like and trust you?
Right.
And honestly, because of Madoff and Shrinker and other jerks in the world, the other 3 don't matter as much anymore. We tend to affiliate and work with people that we like and trust. And I think you should.
Sure, yeah.
But I do think there's 3 more steps to that relationship. The second one is, do you think we know what we're talking about?
That's pretty important.
It does matter. Having a securities license by itself does not qualify. So my daughter's at Anderson University. She's in her life group, and she calls me in a tizzy. Kendra is black and white. There's not a lot of gray in her life. And she knows the things that we do and that I have done in my career to be able to be where I am. So this young man is going to work for an insurance company. I think it's Northwestern Mutual. And he has to have a series of names of people to show that he's got enough people that he can call on to get this internship or to do his program. And so I don't know how the conversation comes up, but he tells his life group that there's no difference between a financial representative and a financial advisor. And Kendra goes bonkers, calls me and says, Daddy, tell me that I'm not nuts. And I had to tell her she was wrong.
Okay, say that again. Financial advisor and financial
there is no, and it's sad, but it's true. Legally, you can call yourself a financial advisor, Sherry Contos.
Really?
Legally, anybody can call themselves.
I could put a shingle up and says that.
There is no legal restriction on being able to be called a wealth manager, a financial planner, a financial advisor, a financial representative. They are merely titles that are self-appointed.
I see.
Now, he can't say that he is a certified financial planner any more than somebody can say that they're a CPA for certified public accountant without being board certified. But having a securities license does not make someone know what you need them to know about your financial life. So 1, do you like and trust them? 2, do you think they know what they're talking about, and how do they prove that? Right? That's why I think every one of my planners is enrolled in the CFP program to become certified financial planners. Every one of them are on our planning team.
Yeah.
We think that educational part is important. The third is, do you understand our process? And then the fourth is, do you need our process? I think, we take care of people who don't want to worry about their money. There are some people who want to worry about it, who want to be daily involved and adamant about it. We're not probably right for you. This is a full service financial planning firm where we get paid as registered investment advisors to manage money for people, to make sure that they don't have to worry about their retirement, that they don't have to worry about things. And so the thing that gets left out of most conversations, in my opinion, is the business model. So you found Joe, you like Joe, you heard Joe on the radio. Joe's a nice guy. Joe's done it for 29 years, blah, blah, blah. That's wonderful. But what is Joe's business model? How do you know before you put your life savings with us at TD Ameritrade, where we hold our money? We don't have it at the Financial Enhancement Group. I tell TD Ameritrade what to do with it. But how do you know that I'm going to be here tomorrow? And does that matter? And the answer is yes, it matters a lot. The reason it doesn't say Joe Clark and Company on the door is because I wanted this to live a lot longer than me. There's 21 people on our team. There's more than 600 families that we take care of. We're continuing to grow, hence having to build the new building, because we don't have the space here to be able to handle it. But you need to know what that business model is to know that we're going to be here next year to be able to do the things that we promise. Not just the things we intend, but the things that we promise.
Right.
The world is scattered with good intentions, as my grandfather would say.
So my question is, you say it's important, number one, to know and trust the person, and then the other things. But so do you need to know who the team is too? Do they need to know who your team is too? Because you may not always be here.
We do our best to make sure that people know who the team is. So in every meeting we have, I always have a paraplanner in the meeting with me, and we now started having another planner actually in the room with us. And it's for that very reason. And those that have listened to the show a long time know that I lost my mentor and dear friend December 11th last year. He did not have paraplanners like most of the industry. But people walk in and they go, we got a packed house here. And it's like, no, we got you because you're the center stage. You matter. I have my paraplanner to be able to make sure that we don't lose any of the information about you and that everything is done. And if God calls me home early or I'm hiking and I'm not here and you need help, I want people who know your situation, your information, and who are also qualified to be able to give you those decisions and information in my absence for one reason or another. Now, again, I'm 50. I'm going nowhere. But the communication part and that business model part matters.
You cover it, yeah.
So in the communication, what should you get? There is a massive move of money to the independent channels, as they call it. Those are registered investment advisors. So people are leaving the Wirehouse, the Merrills, the Morgan Stanleys en masse. And if you pay attention to the news, so are the brokers. Merrill, they're losing people because the money is going to the independent channel. One thing, always make sure that you get 2 statements from those people. So you get a statement from the Financial Enhancement Group. You get a statement from TD Ameritrade. They're never going to be identical because they're put out on different days, but they're close enough to know that nobody's running off with the money.
With the money, yeah.
When I see the 13 people who've stole money, from Madoff to Shrinker to the other people, in my 29 years, I've seen it happen 13 times. They all had one thing in common. They only sent people one statement. So you got something in the mail that you wanted to believe to be true. Yeah. And so you didn't ask any questions, and then bad things begin to transpire.
Yeah.
So on our statements, because I think it's so critical, it doesn't just show you the amount of money that you have. You saying that you have $1 million, but it's all in a 401k or an IRA that's tax deferred is not the same thing as having $1 million that you've already paid taxes on.
Sure.
Or $1 million that's in a Roth IRA. So we show the tax diversification on the statements. Secondly, every week we put together the Market Carver. And there's a short one that's free for all you listeners. You can get emailed to you if you just go to our website at yourlifeafterwork.com. Get signed up for the Market Carver. It'll come to you every Thursday at 1 o'clock.
It's easy.
If you're somebody who just listens to the show, there's a much more in-depth, detailed one that goes to the families we serve at 11:04 every Thursday morning.
Wow.
And of the 600 plus families we have, about 85 people open it.
That's cool.
It amazes me the energy we put into it, and only 85 open it.
Oh.
But we take care of people who don't want to worry about their money.
I bet statistically that's high.
And coming here is not a job, right?
Right.
You're not putting your money here so that you have another job. And if you want to watch the Market Carver, outstanding. If you want to, when you come in for your FEG family update, when we run through the 5 critical elements, if that's all you want to make sure that your financial life is in order, then God bless. But key thing, guys, is it's not just the person in front of you. If you think I can do this on my own, you are mistaken. You need to understand the business model and the team that supports it. Ask how long they've been there, why they're there, why they love their job as well. Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. We got to take a break, but we'll be right back. You got a question or comment? Shoot me an email. Consider this at yourlifeafterwork.com.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. The show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
Happy to have you along. One of the things about being around for as many years as I have, and being able to speak financially in essentially three different fronts. I guess the one is a financial practitioner. I'm the managing partner of a registered investment advisory firm. This is our 20th year in being in business, my 29th year in the industry. So I'm able to talk as somebody who does this for a living, where my resources come from. The second way I'm able to talk, though, is as a certified financial planner and the advocacy director for the FPA of Greater Indianapolis, Greater Indiana, we call it. So I'm on their board. And then the third way is the academic side. I taught financial planning in the senior level at Purdue University for 14 semesters, 7 wonderful years. So I get to talk in 3 different ways, which means I end up being quoted in a lot of media. One of the places that I write for is Investopedia. And they always send out a series of questions and ask us to answer. And so we decided to answer some of those questions today. So I have not read the question, Sherry.
Why not?
So you go ahead and ask.
Okay. Well, the first one is the question, do financial advisors provide strategies to protect one's assets? So they help accumulate wealth, but do they also provide strategies for asset protection?
They should, but like we talked about on the last segment, a financial representative, a financial advisor, wealth manager, financial planner, anybody can call themselves those names. It's your job to know the business model and how they actually do it and ask those questions. In my mind, you should always look for a certified financial planner. That way you do know that they have at least the knowledge base that's required to be able to do some of that.
Yeah.
Everybody in our company is enrolled, that's a planner, is enrolled in the CFP program or is already a CFP.
Right.
And we think that truly matters, that education matters. So you really want to ask people where what their focus is, if you will, in terms of how they help people. What is their process? And ours is a trademarked process that we're able to go through. Now, again, the firm's 20 years old. We are better today than we were when we started.
Sure.
I had the best of intentions then as we do today.
But you learn as you go.
If you don't learn as you go, you're making a mistake.
Right. Yeah.
So I hope 10 years from now, we're better than we are today. Right. That doesn't mean wait 10 years to come find us.
Right.
But when you ask those questions, our process is to help you determine a financial vision. It's not quantitative. It's not a number. It's qualitative. What do you want your life after work to be like? Right.
Yeah.
In your words, a couple sentences. And then there are 5 critical elements that we help people walk through. Your life after work, which some people would call retirement planning. So yes, there's strategies there to help you get the money out. But the second along the way is the tax planning. And it's got to be done every year before December 31st.
Yeah.
So our process includes a letter that goes out first week in October that says, have any of these 8 to 12 things happened to you, your parents, or your children? When we want to pay attention to 3 different tax brackets. The third thing is the investment playbook. What's going on in the market today? Yes, we're registered investment advisors. Yes, I worry about the UK and the Brexit and the French election, and that's my job.
Right.
The fourth thing is life happens. It doesn't matter how well you've saved. It doesn't matter all of the things that you've done right in investing and accumulating. It doesn't matter if you've done a perfect tax planning. There are things in life, the good, the bad, and the ugly, that can just knock you off your rocker.
True.
Your daughter comes home from college pregnant and says, "By the way, we're getting married." You've got your emergency fund build up, and all of a sudden the engine blows in your car.
Right.
There are good things that happen. There are bad things that happen. There are ugly things that happen. And then last but not least is the legacy plan. So yeah, it's fair, but you've got to ask that person that you're talking to, what is their system? What is their process for helping? And if your first question ought to be, are you a fiduciary? And if they hesitate at all, you don't want to be there. The second question then is where does that knowledge base come from? And it's My grandfather taught me the smallest deed outweighs the grandest intention, and that the world is scattered with grand intentions.
Right.
So ask people, okay, this is what you do. Show me how it works. Show me that you've done it. Make sure that they're going to be around the next year to be able to do it again.
Yep. Okay. Second question. This is interesting. Should I stop contributing to my 401k? So here are the details. I am 55 years old. I have about $500,000 in my 401k. I have nothing in any other retirement program other than Social Security. Is it valuable or even worth it to stop contributing to this 401k and do something else with the money?
Good question. It's a great question. So you really, to answer it correctly, need to have more details, more information. The first one is, and it doesn't matter how much money that you've saved or accumulated. Let's start there.
Okay.
The first question is, the first thing, even if you were starting at 55, if you didn't have the $500,000, some people say, well, you're never going to save enough to be able to retire. That's true. That's probably true. However, my job as your financial planner, as a CFP, my job is to replace your standard of living at retirement,
right?
Not your income. So every dollar that you save today is a dollar that you're not used to spending. It makes it easier for me to replace your standard of living when you finally do retire.
Yeah.
Plus, you do have some money saved up, even if it's not enough to replace everything, right?
Yep.
So that's the first thing. Secondly, never give away free money. So if you've got a 401k, you probably have a match. Let's say the match is 3% or 5%, whatever the match is. Yes, you want to contribute up to what that match is. Free money, good money.
That's usually the case?
It's usually the case. Most places have matches. You know, at the Financial Enhancement Group, all of our people have 401ks. We don't match. We actually put the money in for them.
Yeah.
Because I want everybody to participate.
Sure. Yeah.
Right?
Yeah.
So you've got those are stage two. Now the third is where the question really comes into play. Is if I've saved up money and it's all in one type of tax treatment, right? It's all tax deferred.
Okay. Oh, yeah.
Now the question is, should money go elsewhere?
Right.
And that part of that's going to depend on your tax rate today, what it's going to look like when you're in your future when you retire. Part of it's going to depend if you're married or not, what your spouse has done or hasn't done, because again, that very much drives the tax rate in terms of where you are.
Right.
I would ask if you had a Roth opportunity at your place of employment. And again, you may be able to use the Roth option inside of your 401k, not for the part that the business puts in, but the part that you contribute. About a quarter of the plans in the country today have a Roth option. Eventually, they all will. Some people are just late to the party. If you're putting in enough to get the match, and if you qualify for a Roth IRA, then in many cases, we would tell you the next best place is to go with the extra money would be a Roth IRA. But I need to see your tax return first.
Sure.
Right? And we need to know some other stuff.
So we don't have enough information. Okay, real quick question, because we're almost out of time at this segment, is how much should I have allocated in international equities? This is a long-term and active investor with an unusually low risk profile.
Well, anytime you move outside of the United States, you add a couple more risks to it, right? You add currency risk for certain, and you add regulatory risk in a different environment. You may have just seen that apparently a GM plant was seized in Venezuela. So you have a couple more risks that are there.
Right.
I will tell you, as registered investment advisors, you know, our families that we take care of have long-term plans, but they have us managing the money. So we know what their tolerance for risk is.
Right.
The last 5 or 6 years, we've had a 0% allocation to international equities.
Really?
Because there's not been any sense to be there.
Right, yeah.
Now, recently, we've moved that closer to 10 to 15% based on data and information we're getting this year
That
and
is
market
interesting.
flows. So it's hard for me to answer that in an honest fashion. As a CFP, they would have taught me academically. The answer is between 10 and 20%, depending on your level of tolerance. Larger economies, not smaller economies, the more or the less risk tolerance that you have.
Right.
As a registered investment advisor, kind of look at life a little bit different. Hey, you're listening to Joe Clark, Sherry Contos. Consider this. You got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. We'll take a break. Be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Welcome back to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
Happy to have you along.
We are.
We're in the middle of answering Investopedia questions. So, Sherry, fire away.
Yeah, I like this one, actually. If you had to give a young adult one piece of financial advice, what would it be? And the person who asked the question, 22 years old and has developed a vast interest in personal finance and the economy, what would be the most critical piece of advice you would give?
Well, it's easy to understand that what is talked about the most is the one that becomes the most dominant in people's minds. And for instance, in the last 2 weeks, I've had more people ask me about gold than I have in probably the last 6 months.
That's interesting.
And if you look at the commercials on CNBC or any place else, here's what they're saying, and it's understand anybody who talks about gold is not regulated. There is no big brother watching them, and though I'm against regulation, I don't like it when people are able to be lied to. So what this commercial says is that the dollar is falling. And in case you missed it, the dollar is at highest against the UK and the British pound since 1981. Very, very high relative to the euro. Yeah. In terms of where it was, the dollar is not falling. When, if anything, we would like it to come down a little bit relative to other currencies because it helps our exporters and businesses internationally. And then the second thing they say is we're in a bear market. The bear market technically is when the market has fallen by 20%. In case you missed it, it's been on a rise since March of 2009 and not a lot of volatility the last 3 or 4 years.
Right.
So the first thing that I would tell a young person to do is to try to stay away from anything that drives commercials where people are paid for a particular opinion or a bias. The biggest thing that you need to know to be able to be successful, in my opinion, is to understand your tax return, understand how it works. And I say that because most people never have tax planning their entire lives. Now, I know some of you say, now, Joe, I've got a CPA. That's not true. Ask your CPA if he does tax planning with you, because you have to do tax planning before the end of the year.
Yeah.
Right. So, I work with Huth Thompson in the Lafayette side of the state, East Step Doctor and Company here on the east side of the state, Huth Thompson on the west, I think I said. East Step and Doctor out of Muncie and Anderson. And in the tax planning that we do jointly has to happen before the end of the year. Right.
Yep.
So most people never have somebody who says whether it should be a Roth 401k or a Roth IRA or tax deferred. Nobody has anybody talking to them about whether or not they should stack itemized deductions 1 year and take the standard the next year. There are things that are missed. So you can find plenty of sources and people to give you information about the market to take care of your every whim and worth, and that's just going to increase.
Sure.
You need to spend time understanding your tax return so that you can take that investment wisdom and apply it correctly to your 1040.
I think of all the times we've done this radio show, that's the one thing that always sticks out to me is the tax planning, how important it is. I had no clue till I started doing this.
It's critical. So, and most people don't. They're on autopilot. I know. And it is the second part of our 5 critical elements, right? In terms of our process is the annual tax planning. When you look at the fiduciary focus, the 4 things that I tell you that if you're doing this on your own or if you're working with a broker, the 4 things that you've got to write out are risk and volatility, fees and expenses, taxes. Both today and tomorrow, and then the 4th is real return. Right. They all 4 matter, and the tax planning is the one that probably gets the least amount of attention.
It's a strategy. It's a strategy.
It's very much, it's an ongoing strategy. Because as you like to get frustrated,
I do.
The rules change.
I know.
We have our group meeting for the families that we take care of twice a year. So it's like having 4 weddings. I realized that it's about 125 people that come to one in the Madison County, Indianapolis area. So we do it in Pendleton, and then we've got the one in Lafayette that we just had. About 110 people were there. And we talk about the things that are going on. And in the taxes, this being our 20th anniversary at the Financial Enhancement Group, I went through the changes that have taken place in the tax code the last 20 years. And I only brought up 10 points, but in truth, there were probably 30 that we have had to apply or been able to apply to make the financial journey of the families we take care of better, right? When I started, there was no Roth IRA.
Yeah, that's crazy.
When I started, few people qualified for a Roth conversion. There were no charitable or QCDs, charitable qualified charitable distributions for out of RMDs. There was no difference in dividends and capital gain taxation. So it's.
And how does the average person know all that? That's what just kills me. I know.
They just ignore it.
I know they ignore it. Okay. So here's a question, pretty simple. This is a young man who lives in New York City, works in New York City. He's only 23 years old and asks, will any financial advisor speak with him?
That's the argument. I'm a big supporter of the Department of Labor rule that came out that says that you have to be a fiduciary to deal with people on their retirement accounts. Everybody deserves somebody who has to function in their best interest.
Yeah.
And no, if you're selling stuff, that doesn't mean that you're a crook. It doesn't mean that you have no integrity. It doesn't mean that you have no knowledge, right? If you work under suitability, it doesn't mean by definition that you are a bad person.
Right.
It does mean by definition that the current system does not force you to necessarily operate in the best interest. Doesn't mean you're not.
Right. Yeah. But you don't
it doesn't
have to.
force you to. Whereas a fiduciary, it forces us to act. I'm obligated to treat your money as if it were my money and we were in the same situation. So part of the argument is nobody will work with that 23-year-old individual because he doesn't have enough money
to make any money,
to be able to come in on his own and for me to work with as a registered investment advisor.
Yeah.
So I created a solution. It's not a perfect solution, but one of the things that we do in here that we're proud of at the Financial Enhancement Group is that we family bundle. So Sherry, when you came in and we sit down with your asset base, you got a fee schedule based on the amount of money that was deposited at the Financial Enhancement Group. So if it's less than $250,000, we charge 2% a year. If it's over 250 but less than $1 million, it's 1.5%. Over $1 million, it's 1%. And we don't stagger it. So you're either at 1.5 or you're at 1 if you, depending where you came in. The nice part that what we worked hard to do is your kids don't have near the asset base that you do. They're young. They've got twins. They're trying to make it. It doesn't mean that they don't need good financial advice. And what happens is they tend to get it from people who sell product, right? That may be trying to function in their best interest, but they still live and die based on the life insurance or the mutual funds or the annuities that they sell.
Right? Exactly.
And it doesn't mean that those are necessarily all evil products, but that when your paycheck comes from making those recommendations, it tends to be the boxes that people find themselves in.
Sure.
We let your kids come in, regardless of their resources, at the same fee schedule that the parent is at.
Which is amazing.
Which lets people get good advice. A lot of times people walk out of here without ever having an account.
Yeah.
We'll tell people that, our process would actually hurt you. You're here because, you're part of our family and we take care of our family. But it is tough for that 23-year-old to get financial wisdom or guidance or advisement. It's one of the reasons I do the show the way that I do.
Yeah.
I do this so it's as informative as possible for people who need to get the education and the information. For those of you who want to come to see us, we welcome you. That's what drives our business. That's why there's 21 of us on the team. We enjoy those new relationships, but we cherish the ones that we already have, and we will take care of your family as if it were our family. And it's a sad question. I still believe everybody deserves a fiduciary.
Yeah.
And I hope that I can get more of you to actually decide that that's what you want to do as you grow up. That's why I work in some of the schools that I do to try to encourage kids. Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. We got to take a break. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
And we are having all sorts of fun. A lot of questions where every week between me and the five people that are on that are planners with the Financial Enhancement Group, see families where new questions may arise, where the families will email us questions, or the newer planner may have a question that they ask that we cover inside of our planning team. And some of those questions come from Investopedia. Some of them come from you. If you got a question, you can always email us, consider this, at yourlifeafterwork.com. But Sherry, you got a couple more questions.
Yeah, this is real life, folks. This is real questions. Should I use the cash value of a whole life insurance policy to buy a universal life policy via a 1035 exchange? So this person has $500,000 of cash value in their whole life insurance policies. Does it make sense to use that money via 1035 exchange to buy a universal life policy?
So this is why it is important to understand things. So you're essentially having an insurance question, which we put under the life happens.
Right.
It's an insurance question mixed with a tax code question, mixed with an investment decision.
See?
Right?
Yeah.
So let's talk about whole life first.
Okay.
Whole life insurance is where you buy a life insurance policy from a company where the premium that you pay should never go up. It's fixed the first year you buy it.
Right.
With that cash value, with that whole life, you have two other columns of assets that go along with it. One is guaranteed cash, right, that you have, and the second is dividends or paid up additions, depending on which way that you go. So you can always have two of the columns. You never get all three. So let's say the death benefit on the whole life policy is $1 million, and your guaranteed cash is $300,000. You can either surrender the policy and get the $300,000 guaranteed, or you can die and get the $1 million. Your family would get the $1 million.
Get the $1 million.
Right?
Okay.
Whatever the dividends or paid up additions are, you or your family automatically get.
Okay. Right.
So that's the whole life insurance part.
Okay.
Universal life or variable universal life, depending on the situation, is a term insurance component that uses the cash value, if you will, that you've accumulated to be able to help offset the cost of the term insurance. So every year as we get older, right, the cost of insurance is going to rise. In the whole life policy, it still rises. You just don't see it because you paid more in the beginning.
Right.
In universal life, you will actually see the cost of insurance charge increase on an annual basis. And the answer as to whether you should move from one to another, we don't have enough time on the show, and I don't have enough information to be able to respond. What the 1035 exchange lets you do is to move money from one insurance contract to another insurance contract without having to recognize any of the taxation. Okay. And yes, my friends, life insurance can have negative tax implications if you simply surrender a policy. You never get a deduction, but you can certainly have taxable income. So the 1035 part makes sense. You can 1035 a life policy to a life policy or a life policy to an annuity.
Wow.
You can never take an annuity to life insurance, but you can also do an annuity to annuity. But it's a good question. I would pay somebody like the Financial Enhancement Group to look at your situation before making that decision. The person who's selling the life insurance policy obviously is getting paid to sell the life insurance policy.
Sure.
Doesn't make it a bad recommendation. We just don't have enough data to be able to answer it without looking at some stuff for more. But you need a third party that truly understands both sides of the equation.
Okay. Next question. Are qualified dividend paying stocks a reliable source of passive income for retirement?
Okay, so let's talk about first what a dividend is. So a company makes money, right? And has profitability.
Right.
So let's say I've got $1 million left over at the end of the year. And the board of directors comes together. They're the ones that make the decision. And you can essentially do three things with that $1 million profit. I can reinvest in my company, right? I can hire more people. I can build more buildings. I can buy another business. I can do any of that I want to do. Companies that are growth oriented tend to do those kind of things. They reinvest back in their own business. The board of directors can also decide to buy back shares. If they think the current company is the value of the current company is greater than the current market price that the stock market is trading at, which happens all the time, the board of directors can vote to buy back some of the shares that are outstanding. So when you hear us say buybacks on CNBC, that's what's happening. A lot of the alleged earning growth that occurred between 14, and 2015 really was because many shares were eliminated as CEOs and board of directors bought back their shares from the marketplace. The third thing that they can do is declare a dividend. And a dividend is a beautiful thing that is profitability that is taxed at the corporate level. So the corporation now pays taxes at their level, which is why you hear the administration talking so favorably about corporate tax reductions and revamping.
Right.
So the corporation is going to pay tax, and here's why it's called double taxation. Corporation's going to pay tax, and then Sherry, you're going to turn around
I'm going to too.
and you're going to pay taxes too on the dividend as a 1099. Now, way back in the time machine in 2003, the market had a horrible year. Obviously, the tech wreck in 2000, 2001 we had 9/11. 2002 was one of the worst years in history for managing money. Hit the low in the middle of October of 2002, went up into the end of the year, and then promptly went back down to mid-March. And around March 9th or 10th, we added a new thing in the tax code where we created a concept called a qualified dividend. George W. Bush and the Congress essentially enacted a rule that said if you're in the 15% tax bracket or below, so 10 or 15, that qualified dividends and long-term capital gains were taxed at zero. So they're taxed the same way. Now, what is a qualified dividend versus a dividend? It's a qualified dividend comes essentially from a company that is based inside of the United States. It's headquartered here and has profitability. So you can't buy a company that is overseas and have a qualified dividend. It's got to be, here in the United States. So it's limited.
Complicated.
Is it? It's not qualified. You get when you get your 1099s, it actually shows you what percentage is qualified and what percentage is not.
Okay.
And now the question is, are dividends a safe and reliable income stream
for passive income for retirement?
And the answer is most companies that pay dividends will continue to pay dividends. We actually, one of the companies that we look for, or one of the strategies we look for in our portfolio, are companies that have an increasing dividend payout ratio, so that they increase the percentage of their dividends that they're paying out.
Yeah.
Dividends have been a huge part of the U.S. stock market for many years.
Yeah.
Not as much the last few, but for many years, they have been a major player. And so we look for those companies that pay the dividends. Just keep in mind, there's a big difference between a dividend yield and a dividend. Right. Mm-hmm. So if I have a stock at $10 a share that pays $1 dividend, right? My yield is 10%, right?
Right.
My income's $1.
Right. Exactly.
If the market goes up and all of a sudden the stock's at $20, but my dividend didn't change, suddenly my yield's at 5%, but I still have my dollar income.
So you look for the ones where the percentage goes up.
We're looking for ones that increase the dollar.
The dollar.
Not
okay.
increase
Okay.
The yield is dependent on what the market pays.
Sure.
Where the market pricing is. And there's a huge difference between pricing of the market and valuation of the underlying investment.
Right.
But yes, dividends are typically reliable.
Interesting.
And it's part of our strategy, especially for people that are in the 10 to 15% bracket, to create income that's taxable there. We also have another one for people who have to participate in the Affordable Health Care Act that produces no dividends, because that does get added on the tax return from an income standpoint. Hey, for those of you on WIBC, you've been listening to Consider This. I was Joe Clark along with Sherry Contos. Appreciate you tuning in. You got a question or comment, you can shoot us an email. Consider This at Your Life After Work. And don't forget to go to the website, yourlifeafterwork.com. For the rest of you on the other stations, we'll take a break and be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
Happy to have you along. Sherry, those of you that are listening,
Yes.
We sure appreciate you tuning in. The questions and comments just keep coming, and I do my best to try to answer all of those. Again, we have 10,000 people a day turning age 65, Sherry. Mm-hmm. We will for the next 17 and a half years.
That's incredible.
It really gets a whole lot worse. 1 out of 5 of you that are listening to the show, assuming I have no toddlers, 1 out of 5 were born between 1957 and 1961.
Isn't that incredible?
And it is. It's never happened in history. And when people ignore the demographic impact of that many people consolidated in that small of an age range, from a standpoint of inflation, remember that when you see the supply remain constant, but the demand rise, price has to rise. It's a basic economic issue.
Yeah.
And so when you looked at that age group of people, 1957 to 1961, it was very predictable when housing would take off, where people would have to buy more homes.
Sure.
But because people missed the demographics, they thought homes were going up for a different reason other than just demand.
Demand, yeah.
So when the prices of houses fell, they didn't understand that the demand had decreased, even though the supply had increased, or that the builders had been there. It's hard to reckon with that unless you pay close attention. Mm-hmm. So one of the biggest things that is coming are these required minimum distributions. And I just want to tell you guys, there's a reason why you don't want to wait until you're 70 to come see us at the Financial Enhancement Group. Getting ahead of required minimum distributions is critical. 70% of you take Social Security the first minute you can get it. Now, I say 70% of you. The people listening to this show
that wouldn't be true.
Are probably not you guys, though. Every now and then it happens where somebody comes in and show that's what they told me to do. I didn't know any better. There's some things we can do to stop that, by the way, and get a reset to a degree, so that you don't lose that 8% annual growth. But Social Security timing is a big part of what we look at. But there are RMD rules and regulations, though, that people don't understand. And every now and then somebody walks in and had never heard the word.
Right.
Didn't even know that they were going to have to take
I don't think I had before
them.
I started the show.
And, well, you're not 70 and a half
well,
yet.
I know that.
But we'll have to do it. So the rule for required minimum distribution, we're looking at your qualified retirement accounts. That means your 401k, 403b, and they are different, and your IRA. So your tax-deferred vehicles, right? The year after the year you turn 70 and a half, you must begin to make withdrawals.
Okay.
Everybody says it's 70 and a half. It's not.
It's the year after.
It's the year after the year you turn 70 and a half. But if you wait until that year, so the year after the year you turn 70 and a half, you have to make 2 distributions, the first one being by April 1st.
Okay.
Now, why does this matter? Well, now that we've got more and more people 65, I don't know about you, Sherry, but I'm seeing people that are 65 that look like they're 50.
Oh yeah.
The older I get, the younger these people look.
I know. It's true.
And I've got more and more people that aren't retiring until they're 68, 69, 70 years old.
Yeah.
Right. And so if you're making a good chunk of change working at 70 years old and you turn 70 and a half, it may make sense if you're going to have no earned income the following year to actually do 2 of those required minimum distributions in the second year. Now, how are they calculated? And the answer, well, first of all, why is there such a thing as a required minimum distribution?
Yeah, why?
And the answer is they were not designed to be savings accounts. They were designed to be able to facilitate retirement. Remember, I told you
IRAs, you mean?
IRAs and 401ks.
And 401ks, yeah.
They're designed for retirement.
Right?
The IRS never thought that people would save up this money and die with it.
Yeah,
But it's as I've told you before, that the statements hit a number where you've worked forever to save that $500,000 or that $1 million, and it finally says it, and now you have to start taking money out of it, and it's hurtful. I mean, because this is no longer a statement; it's part of your identity. You know, it is. As I tell the families we'd serve, you'd invite it to Thanksgiving if you could, right? I mean, and those matter to people, and they're not savings accounts. They were designed to enhance your retirement. So you were supposed to have the trifecta, right? Social Security, the individual savings, and then your pension or 401k and IRAs. So that's why you're forced to take it out. How's it calculated? It's based on whether you're married or not. And then when you reach that magical age of 70 and a half, assuming you're married, you're going to have to take out about 3.45% of the value from December 31st the year before, right? So 2017 ends, or 2017 is here. Your required minimum distribution would be based on the value December 31st, and then the IRS gives us a table for your life expectancy. Now, this is important, Sherry. They don't ask if you're a cigarette smoker, if you were to bar at 3 o'clock last night.
Seriously.
They don't ask that. We're all the same. If you are this age, your life expectancy is the same, even if you're already terminal.
Actuarials don't look at it that way, though.
Actuaries for insurance don't look at it that way,
Right.
but this is actuarially designed. It's based on that law of large numbers.
Okay.
So each year as you get older, the percentage of money that you have to withdraw increases, right? So at 85, you're closer to 7 and 8% a year that's coming out. Now think about it, folks. You don't pay me to make money grow at 3.5% a year, right? I mean, if I earned 3.5% every year, I would be unemployed, right? Now, are there years that are less than that? Sure, markets go up and down.
Right.
But over the journey, you know, we try to keep people over a longer term period of time between 6 and 8%.
Yeah.
And that's my job. That's what we try to do in the most tax efficient manner possible. So here you are at 70, you're taking out 3.45%, and all of a sudden the next year the account's bigger, right? And you're older, meaning you're taking out more
money,
right?
yeah.
And then the next year, and the next year, and the next year, and all of a sudden we're putting large chunks of change on people's tax returns that are not properly being used.
Right.
That's why I recommend you come see me younger. You know, when you're past 59 and a half, there are things that we can already do to try to get ahead of this before you get into trouble. Now, it is also, and it does matter if you're married. Don't forget that. What happens to non-spouse beneficiaries, so your kids, right? At any age, they have to take required minimum distributions. At any age, right? So if you left the money to the grand twins that are 1 year old now,
18
essentially,
months.
right? You know, they're going to take it out based on a life expectancy of an 18-month-old, which may be a fraction of 1%, but you still have to go through the process. There are differences between Roths and Roth 401ks. A Roth IRA, there is no required minimum distribution for you as the owner or your spouse when you die that's left to them. On the other hand, in a Roth 401k, you must take out required minimum distributions. It's not taxable, but you still have to take out the money.
Yeah.
It's one of the reasons I help people roll Roth 401ks to a Roth IRA upon retirement. Again, only do that with a fiduciary. That doesn't mean go buy an annuity or let a broker, have their way with your life savings. IRA aggregation works. So you may have 5 IRAs, not counting Roths.
Yeah.
I can add them together and take all of the money from one IRA to satisfy the required minimum distribution.
Okay.
So the companies by law now have to send you a letter. The custodians have to send you a letter saying this is your RMD for the year. This is your RMD for the year, right?
Right.
And you get one from every place you have an IRA.
You can add them all together.
You can add them all together and take all of that from one IRA. You cannot do that from 401ks. So if you've got 5 401ks, you're taking 5 required minimum distributions.
Man.
If you have 403bs that are under Department of Labor, you can aggregate the 403b, but notice that's not an IRA, right? So every now and then we'll watch a professor at Purdue have a 403b with TIAA-CREF or now Fidelity, and then they retire and they've got an IRA and they think they can take the money out of the IRA, and you cannot, my friends. You've got to take it out of the 403b, and if you don't, the penalty is a mere 50% of what you should have withdrawn.
Yeah.
There is more and more to learn about required minimum distributions. Trust me, today didn't cover it all. But if you've got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com, and I would strongly encourage you, let's get ahead of this before it's too late. Sherry and I got to take a break. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Yes, I know the hour goes by very quickly. I know many of you do not get to hear the entire show because you're listening when you're driving. But for those of you that are able to stick around and hear all 5 parts of the show, we appreciate your sticking with us. If there's something that you missed or you want to know more about it, you can go to our website at yourlifeafterwork.com. The radio show is posted there. So you can go back and listen to particular segments. Every now and then we'll have somebody call and say, "Hey, Joe, will you talk about this?" And we're able to reference back a segment. We already did it.
Yeah.
We already did it. There you go. Doesn't sound like very good English to me, but we'd already had done that in the past. And sometimes we do them again. This week we talked about required minimum distributions. I probably talk about them once a quarter for sure because we have so many people ask the questions
on there too. Sometimes.
Yeah. And we spent, we use the fiduciary focus as our guiding post. Whenever you come in, I'm going to write 4 things on the board, on the whiteboard. I live on my whiteboard. It makes it hard to do radio. But at the top of the whiteboard, if you can just imagine, I write out risk and volatility, then fees and expenses, then taxes, both today and tomorrow. And I don't spell tomorrow right, so I use T and T, right? Taxes, T and T, today and tomorrow. And then last but not least is real return. And as a fiduciary, you have to focus on those 4 areas. And as a result, this show is driven there. Many people say, Joe, you don't spend enough time talking about the economy. You don't spend enough time talking about the market. Aren't you interested? It's my life, folks. I start very early in the morning, and I work on that until about 6:30, 7 o'clock. Wow. And then the rest of my day is a planner. I have a chief investment strategist. Adam Harder is our CFA, and Andrew Thrasher is our chartered market technician. So they're on top of the market all day long, every day. I do my macroeconomic part early in the morning. What's going on with the French elections? What's going on, with Theresa May and having the snap election now over the Brexit or not to Brexit? Those are the kind of things that I have to pay attention to. If you want that kind of information, every Thursday we send out an email called The Market Carver. If you're a family that we take care of, it's a pretty in-depth 7 to 9 minute dissertation over this is what we thought mattered.
Yeah.
If you are just a radio listener and just curious, you can sign up for the Market Carver. You're going to get a 2 to 4 minute version, a little more of the highlight part, but we're happy to send it. Just go to our website, yourlifeafterwork.com, and sign up for the Market Carver, and we are more than happy to have you along. When you've got questions or comments, shoot them to us, folks. We're happy to take them. Hard to believe the next time I do the show, it's going to be May. But it is, and life changes.
Wow.
First week in May tends to be one of the best of the year, and then we have the summer volatility. So stick around, stay tuned. We'll see how it goes. God bless, my friends. Have a wonderful week, and don't forget to email me. Consider this at yourlifeafterwork.com.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com. Have a great week.